We want to bring in some more people from our jobs panel. First up is Douglas Holtz-Eakin. He is American Action Forum president and former director of the Congressional Budget Office. Kitty Richards is senior fellow at Groundwork Collaborative and a former Treasury Department official. Sarah Malik is Nuveen CIO and the head of equities and fixed income. And, of course, our very own Steve Leisman and Mike Santoli. Steve, we'll go to you first. What did you see that really jumps out at you in this report?
It took me a while to find where the jobs were, Becky, because there's a whole bunch of negatives at the top of this report when it comes to the durable stuff and the manufacturing down 8,000, retail down 6.5. But the jobs were created where the jobs have been created. I'm looking here, just found it in the nick of time here. Healthcare up 78,000. I'm just about to get to leisure and hospitality up 48,000. There it is. So that's where the jobs were, and that's where they continue to be. Kind of interesting that you had that retail decline 6,500. Not a big number, but the question is whether or not how they're dealing with all the tariff situation. You did still have an increase in transportation and warehousing. That was up about 6,000. So that's a good number. Kind of up and down. To me, the revisions may be pointing the direction of the weakness that we're expecting to get. They were still positive numbers, but now we seem to be settling down into a lower run rate here on jobs. Still enough to put to people who are coming into the workforce to work, and that's why you have your steady unemployment rate. Looking at the work week has been kind of steady at this 34.3 number, which is a bit low, but you know, we'll take it, Becky. We're navigating a lot of confusion for businesses, and we're hearing terrible anecdotes from businesses, but not showing up dramatically in the jobs numbers.
Okay, let's dig at this from another direction, too. Mike, we are seeing the stock movement at this point. Stocks came back a little bit. Rick pointed out that yields came a little higher as well. I guess the good news here is maybe the economy is stronger than we had been anticipating post-ADP.
Right, Becky, and certainly stronger than perhaps some folks were leaning, given some of those negative inputs like ADP. I do think it's pretty close to the sweet spot in terms of monthly job gains. Maybe you wanted even a little bit stronger to get a more emphatic equity reaction with those downward revisions, but this is fine. It enables investors to kind of, kick their acute concern for a weakening of the economy ahead by several weeks, right? We're not seeing it in the hard numbers just yet, and that's probably important because the Federal Reserve has expressed no real interest in acting anytime soon. So if you have a wait-and-see Fed, you want the real economy to hang in there. Yesterday, the S&P was down about 0.5%. Half of that decline was Tesla alone. So today, you're in the equity futures, you're getting back all of that and a little bit more as the market, let's keep in mind, is up 23% in 2 months off that low in early April. So a rest would not be surprising after this move.
Doug, I guess the question it does beg, though, if the economy is stronger and if the jobs market is strong, you're not looking at higher unemployment. Is that really a reason for the Fed to cut rates? We've looked at the inflation side and said, OK, inflation has not been hot. Maybe the Fed could cut rates. But if you look at the unemployment picture, I guess the question is, should they?
I don't see the Fed cutting anytime soon. Most of this stems from the tariff imposition, and that's a second quarter phenomenon. And I think we'll see the evidence is we'll see the price increases in the second quarter. But I think the deterioration on the employment mandate is going to be in the third quarter. And so the Fed's going to hold because the first thing they're going to see is higher prices. I mean, we've had studies out of the New York Fed, the Atlanta Fed, where they've talked to businesses in their districts, and the majority are passing along the tariffs as higher prices. And so that's going to show up quicker. That's what the Fed has to worry up front. Second half of this year, they're going to talk about cuts, but not yet.
Kitty, you agree that the second half of this year will bring job cuts?
I think that, as Doug was saying, a lot of the uncertainty that's created by the tariffs and other kind of chaotic management of the economy by the Trump administration is only going to start really impacting the labor market on a slower timeline. We are starting to see some of the softening. I hate to see the labor force participation dropping while unemployment stays steady. The revisions downward from the last few months are putting us on a trend for lower job growth. But a lot of the job cuts really come from those increased prices for inputs that are only going to start working their way through the system, and a pullback in investment due to the uncertainty of what's going to happen over the next few months. And that really takes some time to really impact the labor market.
Hey, Rick, who do you think is going to tell the stock market about the chaos if it hits new highs near term?
I think everybody will keep calling it that way, and anybody who has a 401k should keep their fingers crossed that they keep doing it. That contrarian viewpoint keeps fueling more upside. And I would like to point out something. With respect to this quote-unquote deteriorating job picture, the 3-month moving average of non-farm payrolls is 4,000 less than the 139,000 that we had today. So I just don't see that there's this, added negative impetus by all the headlines that are out there. I'm not saying that they're not all accurate and there's not uncertainty, but the market certainly seems to be much more adult about it than many of the analysts.
Why do you think the market snapped back? What is it? I mean, the market's not stupid. Maybe it goes back down and tests the lows, Rick. But what do you attribute it to? Just the level of skepticism and negativity? It was bound to happen.
Yeah, listen, your partners in business don't need to necessarily personally like you or think that maybe your last couple of traumas or outbursts are good. They just need to realize that you're their best business partner. The U.S. is the place to do business. The dollar is the currency to do business in. All the other issues, the emotional issues, the touchy-feely issues, we can put them on the front page of every newspaper, but the market isn't necessarily going to pay attention. It's going to pay attention to business, real business, which isn't driven by emotions, and it isn't driven by, gee, do you like me or not? They're doing business with us because we're the only alternative with the rule of law and all the other issues that many of the newspapers and the websites say have deteriorated, and I totally disagree, and I think the market does too.
Sarah, as an investor, what do you think about that?
Well, there's 3 ways this number is going to impact the markets. The first is the S&P going to 6,000. Second is how the Fed's going to react. And third is what's going to lead us, which is tech. So I think this is a relief for investors. The S&P likely hits its next hurdle, which is 6,000. We cross that and we stay there. Second is how the Fed going to think about it. It gives them a little bit of breathing room. They don't have to rush to cut rates, because what we were worried about is that employment markets tend to crack right when a recession starts. So if the Fed waits too long and employment markets show too much weakness, likely the Fed would fall behind the curve. Third is what's led us out of the recovery since Liberation Day has been tech stocks. I think that continues to lead. We just saw Broadcom report last night. We're hearing basically that there's insatiable demand for artificial intelligence. I think tech continues to lead from here. And looking at this number, what's important is healthcare jobs coming in at 78,000. That's been a big leader for this number year to date. Every month we've seen about 60,000 jobs created by the healthcare industry. And that is an acyclical industry that shouldn't be impacted by tariffs. So that's a positive and should be a driver of the jobs market going forward.
Hey, Doug, what do you think about what Rick was just positing, this idea that it's okay long term, that we may be dealing with some cross currents at the moment, but that investors will still come here, businesses will still come here?
Well, I think Rick's right that people care about doing business, but business just got a lot more expensive with China, 30% or higher. We're on a pause with those tariffs. So,
he's our Republican
doing business
guest.
has gotten more expensive.
Where we find you, Aiken? You're a Republican guest. We got Kitty on the other side. Hold up your end of the bargain.
I'm an analyst. You gotta,
okay.
You got to do the numbers, Joe.
Am I
this
right,
is just
Rick,
about the numbers. That's all there is to it.
I don't think this
That's why I went to Rick.
Should I finish?
That's why I went to Rick. It's like 4 against 1. Anyway,
but Rick is right about one thing. I mean, there's no question the market's pricing the overall economy. Okay. The bulk of the U.S. economy is services.
I hope you didn't sell your stock. I just hope you didn't sell your stock at the low, Doug. I hope you didn't sell your stock at the low.
The good sector is deteriorating. The good sector is deteriorating. That's a concern. Okay. Services are hanging in there, and that's why I think it's the second half of this year where the weakness might show up.
And that's because you think the tariffs will still be on at the current levels at this point? What happens if there is some solution by July 9th? Go ahead, take that one.
No, that's a very hard call. I mean, at the end of 90 days, we have the pivotal moment when the the president has to decide what he's going to do with the reciprocal tariffs, which in their original launch were a clear overreach and a very danger to the outlook for the economy. I truly hope he doesn't go back there, but I don't know what he's going to do. And I don't know what the courts are going to allow him to do. And so it's really hard to gauge that out.
Kitty, I guess I would ask best case versus worst case scenario, and what you tell people about that.
At this point, I think the really important risk to the economy we need to pay attention to is what's going on in Congress. So I think we're absolutely right to look at the jobs report and see the strength in the healthcare sector. Currently, Republicans in Congress are trying to take millions of people's healthcare away and do it to. Yeah, I mean, that's going to be a real problem. There are analysts saying that that is going to filter through to local economies and cause job losses. I
think that
it's going to be a real drag on local economies across the country if that bill passes. And it's going to make it much more expensive to invest in clean energy, which is going to spike electricity prices.
Clean energy is uneconomic. Clean energy can't stand on its own 2 feet. That's why we have such big deficits. We want to pay for things that people don't want.
The tech growth that you're talking about, the artificial intelligence growth that we just heard about driving the economy, requires massive amounts of new electricity, more than we can create by spinning up new gas turbines over the next couple of years. We're seeing huge deployment of wind and solar at utility scale, including in a lot of red states, that is helping to bring down the price of electricity. If we don't continue that utility scale deployment, we are going to see electricity prices spike over the next few years just because of rising demand, and that's going to also be a real drag on economic growth.
Hey, Mike, what do you think from the market's perspective right now? I mean, you've watched kind of the ebb and flow, the up and down, the volatility rise on these things. What do you think the next thing that we'll be watching for beyond this jobs report?
Well, look, I mean, we have the brute force of massive technology company earnings growth that are partly supporting what we've seen in the markets. What the market does is it kind of processes, uncertainty and policy flux into, okay, let me get the weight of the evidence probability for how things are going to turn out here for the private sector. And for now, it's seeing a pretty steady as she goes economy at the moment, with maybe a little bit of downside to some earnings coming down the road. But here's the thing. The stock market got to 6,000 like 7 months ago. We've had two quarters of really good earnings growth from there. Credit markets are great. The rest of the world stock markets are making highs. Everything seems like it's fitting together at the moment. So I don't think you have to jump through any hoops to say there's something extraordinary going on, that the market is managing to do pretty well right here, all things considered. So, I think that if there were going to be negative impacts from policy, we just don't know them yet, or they haven't hit yet. And so I think that's why the market is reserving judgment on that.